In October 1913, a man named Harold Dorsey sat down at his kitchen table in rural Ohio and did something he had never done in his 61 years of life. He filled out a government form, a form that told the United States government how much money he had made that year. Then he calculated what he owed, 1%. He wrote the number down, folded the form, and mailed it to an address in Washington. He had spent his entire adult life, 40 years of farming, trading, saving, in a country where no one had ever asked him that question, where no such form existed, where the federal government had no legal right to know what he earned and no legal mechanism to take a portion of it. And now, at 61 years old, in the autumn of 1913, he was filing the first Form 1040 of his life. Harold Dorsey lived until 1934. When he died, the top federal income tax rate was 63%. He was one of the last Americans to have lived a full adult life before the income tax existed. Within a generation, everyone who remembered that world would be gone, and almost no one recorded what they thought about losing it. To understand what changed in 1913, you have to understand what the country was before it. For 137 years from the ratification of the Constitution in 1788 until the Revenue Act of 1913, the United States federal government operated almost entirely without taxing individual income. The founders were, almost to a man, hostile to the idea. They had just fought a revolution over taxation without representation. The notion that the government could reach into a citizen's earnings and take a percentage of them annually struck most of them as a form of the tyranny they had just escaped. So the federal government funded itself differently. Tariffs, taxes on imported goods, provided the overwhelming majority of federal revenue throughout the 19th century. When you bought a coat made from British wool, a portion of the price went to the federal government. When a ship carrying French wine arrived in New York Harbor, the importer paid a duty before the cargo could be unloaded. This system meant that federal taxation was embedded in the price of things, invisible in daily life, collected at ports and borders rather than calculated from individual earnings. Excise taxes on specific goods, whiskey, tobacco, carriages, supplemented tariff revenue. During the Civil War, a temporary income tax was imposed to fund the war, then repealed when it ended. A second attempt in 1894 was struck down by the Supreme Court as unconstitutional. For the ordinary American, the federal government was something that existed at a considerable distance, at the customs house, at the post office, at the military fort, but not at the kitchen table. The consequences of this system shaped every dimension of American life. A carpenter who built 20 houses in a year kept what his customers paid him. A farmer who sold 2,000 bushels of corn kept the price of corn. A merchant who turned a $10,000 profit kept $10,000. The idea that a portion of that profit belonged by legal right to the federal government, that the government had a prior claim on a share of whatever a citizen earned, did not exist. This did not mean the country had no taxes. State and local governments taxed property, levied fees, collected tolls. A farmer paid taxes on his land. A merchant paid taxes on his building. But these were taxes on what you owned, not on what you earned. The distinction mattered enormously to the people who lived under it. The generation born before 1852 roughly spent their entire working lives in this system. They built careers, raised families, saved money, made plans, and died without ever once calculating a percentage of their annual income for the federal government. When the income tax arrived in 1913, they were in their 60s and 70s, old enough to have a complete picture of what had existed before, old enough to know with precision what had changed. Almost none of them were asked what they thought about it. The 16th Amendment to the United States Constitution was ratified on February 13th. It gave Congress the power to levy a tax on individual incomes, a power the Supreme Court had explicitly ruled unconstitutional 18 years earlier. The amendment was sold to the public as a tax on the wealthy. Its champions argued that the tariff system, which taxed imported goods, was a regressive burden that fell hardest on ordinary Americans who bought those goods, while the rich, whose income came from investments and financial instruments, paid almost nothing. An income tax, they said, would correct this imbalance. It would make the rich pay their share, and in its original form it almost did. The Revenue Act of 1913 set the income tax exemption at $3,000 for single filers and $4,000 for married couples. In 1913, $3,000 was an amount that perhaps 97% of Americans never came close to earning. The initial rate for income above the exemption was 1%. The maximum rate applying only to incomes above $500,000 in 1913 money, the equivalent of roughly $10 million today, was 7%. Less than 4% of the population owed any tax at all under the original law. The New York Times headline called it a tax on the rich. It was designed to be invisible to most Americans, a burden borne by the Rockefellers and the Morgans, not by the farmers and factory workers, but the people in their 60s and 70s who had lived their whole adult lives outside this system knew something that the architects of the tax did not publicly acknowledge. Rates change. By 1918, 5 years after the original 1% rate, the top federal income tax rate was 77%. By 1944, it would reach 94% on income above $200,000. The modest, targeted tax on the wealthy that was ratified in 1913 had become, within a single generation, a mass tax that reached into the earnings of almost every working American. The generation that lived through this transformation, who remembered the world before and watched the tax expand in real time, were the last witnesses to a fundamental change in the relationship between the American citizen and the American government. They saw it happen. They understood what had been lost because they had personally possessed it. This is the part that is almost impossible to recover. We have the legal history, we have the congressional records, we have the newspaper coverage of the 16th Amendment debate. What we have almost none of is the first-person experience of what it felt like to live in a country without a federal income tax and then watch one arrive. The WPA life histories from the 1930s, the same archive that captured the last witnesses to pre-railroad America, to slavery, to the open frontier, contains scattered accounts from elderly Americans describing the economic texture of their earlier lives. What emerges from these accounts is not simply the absence of a tax, it is a fundamentally different relationship between individual economic activity and government visibility. A blacksmith interviewed in West Virginia in 1938 described his father's business in the 1890s. His father had kept no records for the government, no annual accounting, no documentation of what came in and what went out. He tracked his own finances in a ledger for his own purposes, and that ledger belonged to him alone. The idea that the government had a right to see it, that it had a legal interest in the numbers on those pages, was simply not part of the world he operated in. A retired merchant in Georgia, interviewed at age 78 in 1937, described the psychological shift that came with the income tax, not as a financial burden. He was wealthy enough that the original 1% rate meant little to him, but as a change in his sense of himself. Before 1913, he said, his money was his, completely. The government took its portion at the border, embedded in the price of imported goods, and then left him alone. After 1913, he was, for the first time in his life, required to account for himself to Washington, to open his books, to calculate and report and certify. The money was still largely his, but the relationship had changed. This is what the last witnesses to the pre-income tax world understood, that later generations could not quite grasp. The change was not only financial, it restructured the relationship between the citizen and the state at the most intimate level of daily economic life, the level of what a person earned and kept. The withholding system, which automatically deducted taxes from wages before workers ever received them, did not arrive until 1943. That was the mechanism that truly normalized the income tax for ordinary Americans, that made the government's claim on a portion of wages invisible and automatic rather than a conscious annual calculation. The generation that died before 1943 experienced the income tax as a thing they actively chose to pay each year. The generation born after 1943 never experienced income as anything other than the amount that arrived after the deduction. They had no framework for the pre-deduction world because they had never lived in it. The question that the last witnesses to this world could answer, and that no living person can answer from direct experience, is deceptively simple. What did it feel like to keep everything you earned, not as a political argument, not as an ideological position, simply as a lived experience? What was the psychological texture of a world in which your annual income, whatever it was, however modest or considerable, belonged to you completely, without a prior federal claim on any portion of it? The farmers in the WPA oral histories who describe their fathers' and grandfathers' financial lives give us fragments: the absence of the annual reckoning, the absence of the April deadline, the absence of the Form 1040 on the kitchen table. These absences shaped how people planned their lives, how they thought about saving, about risk, about what the future might hold. There is also something the historical record captures in the congressional debate of 1913 that the tax's supporters did not intend to preserve but did: the testimony of people who had experienced the pre-tax world and were trying to describe what it meant to them. Senator Elihu Root of New York, who opposed the income tax, warned his colleagues that they did not understand what they were creating. The modest limited tax they were proposing would not remain modest and limited. Governments always need more money than they have. The mechanism they were building, the legal infrastructure for taxing income, would be used inevitably to take more. He was right.
But by the time it was clear how right he was, the people who had lived without the tax were gone. The last American born before the income tax arrived died sometime in the early 2000s, a person born in 1912 or earlier, who had spent the first year or two of their life in a country without a federal income tax, who had then grown up watching the rate climb from 1% to 94% over the course of a lifetime. They left no testimony, no one asked. Every April, roughly 150 million Americans file tax returns. Most of them have never thought about the fact that this ritual, this annual accounting to the federal government of what you earned and what you owe, did not exist for the first 125 years of the country's history. The people who watched it arrive in 1913, who had lived full adult lives before it existed, are entirely gone. The last of them died before anyone thought to systematically record their experience of the transition. What they understood about the pre-tax world, what they felt when the Form 10440 arrived, what they made of watching the 1% rate climb toward 94% within their lifetimes, all of that is gone with them. What remains is the record, the congressional debates, the newspaper editorials, the IRS archives, the legal history of an amendment ratified on a February morning in 1913, when Wyoming became the 36th state to approve it, and the United States government acquired a power it has exercised every year since. The farmers and merchants and craftspeople who had lived without that power, who knew from their own lives what the country felt like before it arrived, went to their graves with that knowledge intact. No one wrote it down.